Wealth Management Group's third quarter 2021 quarterly webcast. On today's webcast, we have a special guest speaker, Dr. Jeremy Seigel. We're going to get right into it in a minute, but I just want to do a little bit of housekeeping. Just so everyone's aware, today's webcast will be recorded and you will receive a link to watch it back at your convenience. Additionally, if you have any questions that weren't able to be addressed on today's call, please email us at pwm@prestigewmg.com and we'll take care of them and respond to you. With that, I'm going to pass it to our Senior Portfolio Manager, Paul Esposito, to give an introduction to Dr. Seigel.
Hey, Michael, thank you very much. Thanks again, everyone, for your attendance today. Today, I have the pleasure, again, of welcoming back Dr. Jeremy Seigel as our guest speaker for this event. Dr. Seigel is WisdomTree's Senior Investment Strategy Advisor and the Emeritus Professor of Finance at the Wharton School of the University of Pennsylvania. Professor Seigel has written and lectured extensively about the economy and financial markets and is a regular contributor to the financial news media. In 1994, he received the highest teaching rating in a ranking of business school professors conducted by Businessweek magazine. His book, Stocks for the Long Run, was named by the Washington Post as one of the 10 best investment books of all time, and his latest book, The Future for Investors, is a bestseller. And with that, I would like to hand it over to you, Dr. Seigel.
Oh, thank you very much for your introduction, and pleasure to be with you this afternoon. There is so much going on in the market. I'm going to present you around 25 minutes, 30 minutes, but I'm also going to give you an opportunity to ask me questions. So I'll ask 15 minutes of the seminar. So I do have a presentation for you. I need to get the share screen. Let me get that over here for you and share. There we go. My book, Stocks for the Long Run, you're going to see some slides from that. I'm writing the 6th edition of that right now, so and updating it for all the current data that we have. All the warnings that we have, disclaimers. Let's get to that first slide that's so important. There's a long-term real returns here on the markets. And I mean, this tells a story. Long-term real stock returns. Now, this is dividends plus capital gains after inflation. Average annual. I've gone back further than any other researcher. We have now more than 200 years of data, 6.8% per year after inflation. Now, it's going to be a little bit less going forward, but still, this is quite strong. Bonds 3.6. I think that's going to be a lot less going forward, because I think we're going to have a serious inflation problem, or more serious than the Fed thinks. Bills 2.6. Gold just manages to stay ahead of inflation. You can see that over here. The dollar's depreciated by about 1.5% a year. It's worth only a nickel of what it could buy at the beginning of the 19th century, and going down. That's inflation. But you also notice that inflation has had no negative impact on the real returns on stocks. That's very important. Stocks are real assets. They consist of capital, they consist of plant, they consist of equipment, copyrights, intellectual property. These are assets that will withstand the inflationary pressures that I believe we face in our economy. Now, this is what worried me that I saw last summer. This is last summer. I was sitting here in July. We're talking about 15 months ago. And I saw the money supply surge more than I had ever seen it before. This is the M1 money supply. This is the narrow definition of checking accounts, savings accounts, payroll accounts. Up 40% in a period of just 4 months is really quite large. I mean, like unprecedented. Let me show you the broader money supply, and that's the one that most economists look at more closely. That's M2. Now, M2 consists of money market mutual funds, savings accounts, CDs, all your cash assets that you can turn into cash for any time. Now, the important thing to see, the top graph is a 5-year period. We were going along at 5.3% a year, and then bang, the pandemic hits. We push up the money supply 15%, but this is what worries me. Going up 12% a year since then. Now, if you look at the bottom panel here, which goes back more than a half a century, you see that we had the inflationary period that we had in the 70s and early 80s. We had M2 money going up at just short of 10% a year, and that's when we suffered occasionally double-digit inflation. Now, I'm not predicting that, so I'm going to tell you my prediction in just a moment. But that was the highest sustained inflationary period in U.S. history. Then we had a long period, 34 years, in fact, of moderate money growth, 5.5% a year. And then, as you can see from the top panel, another explosion of money. This is what worries me. And let me mention to you that we get that money supply, that M2 money supply, once a month, and we got it today at 1 p.m. The numbers, it's quite lagged, so we just got it for the month of September, and it was not comforting. It is still moving up at a rate of nearly 10% on an annual basis. It slowed down a little bit, but it's still going up way more than a 2% inflation target type of money supply increase. Now, last year, I've been on the media quite a bit. I said that all this money is first going to go into the financial markets. We're going to have a booming stock market. But then, as the pandemic ends, and thank goodness we are getting some really good news on the pandemic. New infections are down by more than 50% now just in the period of the last 3 weeks. Let's hope this is the last wave. As people begin spending, it was going to go into goods and services and cause inflation far higher than the Fed has been predicting. And indeed, I think we are seeing that now. It's not in the official statistics, but it will get there. The way they do these statistics are very lagged in a way. Now, here's another look at how much money we produced. The black line is M2 growth on an annual basis going back 150 years. And last year was an all-time record. The red is inflation. Now, inflation usually follows money by 12 to 18 months. So the explosion of 2022 is coming, explosion of 2020 is coming out here in 2021 and into 2022. So right now we have like a record difference between money and inflation. But as as I was talking to Mike and Paul earlier, I completely disagree with Kathy Woods that we're not going to have inflation. I think we're going to have a lot of inflation coming up this year. Now, not only have we had an all-time record monetary stimulus, we've had an all-time record fiscal stimulus. I mean, just to compare, the total fiscal response that we had after the great financial crisis was $830 billion. The infrastructure plus scaled down so-called social program that the Democrats are producing, that's the gray area in the top. The blue area at the bottom was the CARES Act under Trump, and then a second package under Trump blue. Then the America Rescue Act, that was Biden's act, that's the yellow, and then the proposal of what's going on now. A total of $7.25 trillion. We have never had so much government spending, except when, world wars going back in our history. Now, people tell me, well, Dr. Seigel, the Fed produced a lot of money last crisis, didn't turn into inflation. They did quantitative easing. In fact, they started quantitative easing under Bernanke in the last crisis. Here's the big difference of this. All the reserves that were created by the Federal Reserve and its monetary policy, and by the way, that's my specialty. I got my PhD in economics at MIT, did my dissertation on monetary policy, monetary theory and policy. That's my specialty. So the Fed is my specialty. Central banks are my specialty. All the reserves that were created during the Bernanke period went into excess reserves. They were not, by and large, lent out to businesses and consumers. And that's the big difference today. Today's money is directly has gone into the bank accounts of firms, individuals, and governments. And let me just mention to you, my first teaching position, I was very honored. I was at the University of Chicago, and I was a colleague of Professor Milton Friedman, who's received the Nobel Prize for his work in monetary economics. I had lunch with him frequently. And I remember him telling me, he said, Jeremy, he said, if the Fed does open market purchases, it stays as excess reserves, that's important. We could have avoided the Great Depression if we had that. But if it gets into the money supply, he said, it is far more potent. That's what's happened this time. It is not just sitting as excess reserves in the banking system, which was important. Because the banking system was starved for reserves back then. I actually support the Bernanke's policy. But what I'm saying is this time, it's gone right into the bank accounts because the PPP program, the tax cuts and everything, basically the government's writing checks to everyone and giving them liquidity like they never saw before. My prediction for inflation, and I've had this prediction now for 9 months, that over the next 3 to 4 years, we're going to have a cumulative inflation of 20 to 25%. No, not in 1 year. I'm not talking about double-digit inflation. And who was it? Was it Dorsey who just yesterday said hyperinflation? No, I'm not talking about hyperinflation. And I don't know, no one knows whether it's 20% going to be 7.77 over the next 3 years, 5.555. I'm just saying we are going to see inflation that we have not seen in 20 and 30 years. Then we're going to get back. But in the meantime, we're going to have like a hump of higher prices. And that's what we are beginning to go through right now. All right. I think, and those of you, many of you I know watch the NBC, they seem to want me to be on every week. I have to turn down a lot of their requests, but I do enjoy being on there. I'm a teacher, and if I can inform people of what's going on, I'm more than happy to do so. I have turned cautious on the market near term. I'm still a big long-term bull. It's the place to be. And I myself have not cut back on my holdings. I don't try to time the market. I think that's a fool's errand. But I think that the Fed, sometime in the next several months, will be forced to accelerate its taper and raise interest rates higher and sooner than the market is expecting. This will cause what I call taper tremors, not taper tantrum, but taper tremors in the market. So I think I think we're going to have some volatility coming up. And as I say, I don't try to play this volatility. I'm not a short-term trader. We could have a correction, but we could go up 10% before we go down that 10% or 15%. I do not think we're going to have a bear market. And I'm very bullish long-term. But I do think that we have volatility facing us because I think we have more inflation than the Fed wants to tolerate. Remember, and I showed you on that very first graph, the stocks have historically tended to do very well in inflationary environment. They can pass on costs. They will be, especially if they've locked in these very low interest rates on the bonds. They're going to be paying off in depreciated dollars. I think this is a very positive, inflation. The only thing is the stopping inflation that gets the rockiness. But and by the way, it'll also affect the property market. So, it affects everything as the Fed has to slow things down. In the meantime, you're holding real assets. Remember, that's the key. Real asset. What's a property? Commodities, stocks help you over the hump. All right. Paper trimmers in our future. I don't really think the market has yet discounted it. All right. What about, is the market crazy high? No, not really. Here's the price earnings ratio, which is the, I think, the most fundamental and useful yardstick for judging on the S&P 500 over the last nearly 75 years. By the way, do you see the trend is upward? The trend is 20 PE now. We're above 20. We're about 22, and I'm going to talk about that in a moment. What does that mean? So the trend is upward, as it should be. Lower interest rates, more liquid markets. Let's go to understanding. How can you convert price earnings ratios of the market into returns of the market? And the process is very simple. You take the price earnings ratio and you flip it. Take the reciprocal. That is a term that we economists call the earnings yield on the market or on a stock, the earnings yield. You've heard of dividend yield, dividend over price. Earnings yield is earnings over price. It turns out that for the market, now this does not work for individual stocks. Works much better for the market. The earnings yield predicts long-term real returns. So when I say predicts, there's a big standard error here. In other words, nothing predicts perfectly the stock market. But let me give you an interesting fact. Over the last 150 years that we have earnings, believe it or not, we do, all the way to 1870. The average price earnings ratio of the market is 15. 1 over 15 is 6.7. Now, do you remember that long-term real return that we have in stocks? 6.8. It's not a coincidence that these numbers are virtually the same. It is exactly what finance theory would have predicted. Again, it doesn't mean year to year either. I look 3 to 5 years out when I make my predictions. So let's take a look. When I prepared this slide a few days ago, for S&P was about 4,500. Now it has actually moved up a little, almost to 4,600 today, new all-time record. They're selling for about 22 times the next 12 months of S&P earnings. Now, let me say a couple things. The estimate is 211. I actually think we're going to break that estimate. I think it could be closer to 215 or 220. So what does that mean? Well, if you take the two, you find out that 4,500 divided by 211 is about 22. So 22 is the PE ratio. 1 over 22 is 4.6%. Real return, that means after inflation. So important in an inflationary environment. Now, this is more than 5 percentage points over Treasury bonds. Real return on Treasury bonds, if you go into the TIPS market, which is the Treasury inflation protected securities, -1, less than -1. The margin between stocks and bonds, called the equity risk premium, is now very high, almost double its historical average. So I like stocks so much better than bonds. Not saying you shouldn't hold any bonds as risk hedges, but I'm just saying, looking as forward-looking returns, stocks are just totally dominant. Now, a lot of people ask about, well, what kind of stocks are we talking about? Value stocks or growth stocks? Well, here is the index of value stock price earnings ratios versus growth stocks. And we've had 3 episodes where growth has accelerated, but value stocks have lagged. The first one about 50 years ago. You have to have a lot of gray hair, like I do, and remember the Nifty 50 mania, 50 stocks that were high PE stocks that were bought by pension funds. They didn't care the price. They subsequently crashed. I think almost all of us remember the dot-com mania. It was only 20 years ago, the second arrow. And now, I want to say something to people. Say, as soon as I mention .com, people say, Dr. Seigel, are you predicting a crash of technology? No. Technology stocks are so much better grounded today than they were back in 2000. But over the next 12 months, if you were to ask me, do I think the value stocks would outperform? I think yes. I think yes, and I'm going to talk about my reasons in just a moment. All right. I want to mention something else. We at Wisdom Tree, as you know, I'm an advisor, investment advisor. We've been looking at concerns of individuals, and we know that a lot of people who start there want to set up a retirement account. And what are their goals? Their goals are, first of all, they want to draw so they can enjoy their lifestyle. They don't want to run out of money, obviously. So they want a cushion in case of a bear market. If they can leave a legacy, fine. And of course, they want it tax efficient. It is our belief that the 60-40, and this, by the way, we formulated this before the pandemic, and I think it's even more true since the pandemic. We believe that you need more stocks today. You need a 75-25, and that's our portfolio. And guess what we did? We were the first ones, and I have not seen this anywhere else, that actually have done what is sometimes called a Monte Carlo simulation, which means we've taken historical returns, jumbled them up, and simulated portfolios thousands of times. And asked the question, what is the probability you're going to run out of money at different proportions of stocks and bonds in your retirement portfolio? This is a 30-year portfolio. On the left, it is a portfolio of all bonds. All the way to the right, it is a portfolio of all stocks. The blue bars represent the probability of running out of money if you take a 5% withdrawal rate every year. So for every million, you spend 50,000. We also did it if the withdrawal rate is only 4% a year. Those are the red bars. Obviously, the probability you're going to run out of money is lower if you take a lower draw. But this is what surprised us. Actually, I had an intuition. That's why I wanted to do this. Moving from a 60-40 portfolio to a 75-25 portfolio actually lowered the probability that we were going to run out of money, even with the extra volatility of the stock market. And the reason, because of the income difference. The projected returns on stocks and bonds are now so large that it overtakes the volatility to push you towards a more stock-intensive portfolio. Now, please talk to your advisor. Everyone has their own risk profile. There's no right portfolio for everybody, no single one. But one should consider this fact. It's almost like having your cake and eat it too. My goodness, have more stocks and actually have that the probability of running out of money less. Again, it's a probability. And of course, by the way, your end of wealth, which is your legacy, is more. That's not a surprise when you go more to stocks. In fact, it's about 36% more median end of 30 years, how much you're going to leave. In fact, for every $1 million in a simulation with a 4% draw, you actually leave 1.13 million on expectation. So if you have a $5 million retirement portfolio, the expectation is you'll leave around $6 million at the end of 30 years if you draw 4% a year and 5% a year. We have two different ones. Now, let me summarize because I want to give time for your questions and answers, my answers. I believe bond yields very well may still rise to 2% by year end. I think the 40-year bull market in bonds, it's hard to believe. I was just an assistant professor, 1981, when the 10-year yield hit 16%, and we've been going down now with interruptions for 40 years, and I think last year we ended it. Now, people say, Dr. Seigel, why aren't, if you think there's so much inflation, why aren't bond yields higher? It's a good question. If we had longer, I would discuss what's called the hedge demand for treasuries. It's huge. People buy it as insurance, even when they know the return is not likely to be good, especially after inflation. And that hedge demand has grown over time for various reasons. And that is why yields have stayed relatively low. But we're still up well over, 1 percentage point from where we were a year ago. Value stocks are likely to outperform 3 reasons. First of all, with the Delta wave moderating, the reopening will really proceed in a much more confident way. Second, if we have rising yields, that's going to favor the value stocks over the growth stocks. And third, and this is very important, people say, well, Dr. Seigel, I see you're not that enthusiastic about bonds except for hedge. What about where can I get income today? Don't ignore dividend-paying stocks. Our studies have shown that they are basically inflation resistant. You can get good 2, 3, 4% dividend-paying stocks. Now, I'm not saying that they don't have the surety of the bond, but over long periods of time, their dividends have moved right with inflation. And again, remember, if you buy government inflation-protected securities, you get negative yield. All right, what about taxes? And I say personal and corporate. Well, I don't even know. Hey, yeah. I mean, Kristen Sinema, she may have, by the way, I think one of the reasons the stock market's rallying the last 3 or 4 days is all of a sudden what they thought might be corporate tax increases may not happen. We'll see. I mean, there's still a lot of negotiating to go. Before that, I was pretty sure that, not the Biden agenda, that was way too aggressive, but I thought we were going to raise the corporate tax to 25%. Now I'm not so sure. I do think there will be higher taxes. They're going to take away basically the Trump taxes cuts that he did. So there's going to be a little bit of that. And the Fed may be forced to tighten earlier, but this is really important. Tina, even though I predict stock returns lower than the long run average, I still pick healthy returns and compared to bonds, dominant returns. Real assets are in fact the answer in an inflationary environment. Now, I want to return to my initial slide and say just one or two words before we go to your questions. I said there might be some volatility coming up when the Fed is forced to try to slow this coming inflation. This might give people, oh my God, market is down a bit, correction, whatever. Should I stay in stocks? Look at the stock line here. Look at how many bear markets we have. Severe bear market, and I don't even predict one. A little bit above the line, we may have to go a little bit back toward the line. But here, look at the returns. Where do you want to be? Where do you want to be? And I am still very pro-equity in the type of economic environment that we have today. So with that, let me stop the sharing here, get back to our main screen. And Michael, or...
Yeah, Dr. Seigel, thank you so much for that presentation. I think I speak for everyone. We said it was very informative and interesting always to get your takes. I'm going to kick off this first question because I do have a personal interest in your response to it. In the recent crisis with COVID, the Fed's response seemed to be much more aggressive than it was in years past. Do you think that they've set a precedent that they can't kind of go backwards from when it comes to future crises? Of course, every crisis will have its own flavor, but just want to get your takes on that.
Yeah, this question's been asked, and that's a really good question. For years, if not decades, do you remember we used to talk about what's called the Greenspan put? Was the idea was that if the market starts crashing, the Fed starts providing liquidity to prevent a crash. But I think you're right. I mean, if we will have more of an inflationary economy in the future, the more the Fed just floods with liquidity every time there's a downturn. And by the way, I think that Jay Powell, I respect him. I think he will be reappointed, but I think I think they are behind the curve. That expression means they should have been tapering by now in order to slow down the coming inflation.
One of the questions the client had, this is Roy Williams, by the way.
Oh, hi, Roy.
The disruption of the supply chain and the California ports, what do you think the impact will be on earnings with the supply chain issues that we're having?
Right. Well, let me say two things about this. One is that we say the word supply chain, and that is the proper name. But this is really caused by a burst of demand for goods that was unprecedented. If you take a look at the goods portion of retail sales, they've exploded. People couldn't go out to restaurants, the service sector, the travel sector, what we call services, and everyone started buying books. They had all the money, and part of this supply problem is because of excess demand. So, it's going to manifest itself in higher prices. However, now, how much is it going to affect earnings? I think the firms are going to pass along the prices, higher prices, and I think a lot of consumers, they're going to shrug their shoulders and say, yeah, oh, wow, this costs more, and then shell out. Now, in some cases, some firms will not be able to recoup all the increases. In other cases, they'll recoup more. So I think there will be some isolated, really, problems of margin compression, but others will have no trouble maintaining margins. It's going to be a pass-through. It's going to be like restaurants. You're going to pay more for labor. They're paying more for their food and everything like that. They're just going to, until you print up a new menu. It's easier than ever, right? You used to have to print menus. Now it's all done by computers. They can print them every day. Who knows? When you go to a restaurant now, you want to get lobster, you see market price. We maybe see more market prices there as they say, well, we have to check what the price is because things are going up. But I think that...
So Dr. Seigel, go ahead.
Yeah, I do think that by and large, earnings will be protected. Yes.
Do you think that we should go Christmas shopping early? Should we start now, or do you think it's going to be sorted out by year end?
I do not think it's going to be sorted out by year end. And if you see something you want, I buy it now. Retail sales in November might set an all-time record because everyone doesn't want to wait till December because they're going to say they think the shelves will empty. Who knows? We might actually, as a result, have some things finally come through in December that you could get in November. Who knows the psychology, of all that? But we did a little shopping for our granddaughter early. We saw a couple of things we thought she would like for the holidays, and why not?
Yeah, you got to pounce on it when you can. So we're U.S. focused in terms of our portfolio, but there's a question that came in about the Evergrande situation and the Chinese economy, and will there be spillover to the U.S. and the rest of the world?
And I think, I don't think, I'm not worried about the Evergrande, like a bankruptcy. I think it's just their whole housing sector, I think has been over speculated. And I think there's going to be a slowdown in China. I'm not worried about a crash of bonds and a junk bond crash and infecting other credits and all that. That doesn't worry me. Now, the slowdown in China affects the sales of things in China. How many Apple iPhones are sold there and other things. But, will it affect us? Well, not directly. We will have supply chain effects, but it's really going to be a slowdown of firms that have a lot of sales in China. If they go into what we call a mini recession, they don't really have recessions because their growth is higher, but they really might go into a mini recession, not because of the bankruptcy of Evergrande, but because finally they're going to have a slowdown they've overbuilt in the housing sector. So China's, and of course, if you own Chinese stocks, you will feel some of that. And one reason why they've gone down is precisely that. So, but I would not worry too much about that in the U.S. stock market.
Now, I know you talked about COVID and the numbers are looking a lot better and improving. But one of the questions are you concerned that the U.S. could go into another lockdown in the future if a new strain emerges?
Obviously, if a new dangerous strain emerges, it is possible. The history of pandemics does not generally point to that direction. That suddenly in fact, I've talked to epidemiologists who talk about what really happens is less dangerous strains. They might be more infectious, but they're not more dangerous. And we've got so many therapeutics. Not only have the Regeneron therapeutic, and Merck, as you know, is developing a pill to take like Tamiflu. The coronavirus may be endemic, in the sense that it's going to be with us all the time, just like the flu is with us all the time and kills from 25 to 50,000 people every year in the United States. I hope it'll be less with COVID, but it's the nature of viruses. My feeling is that we have passed through the last wave, and that we will see a reopening of the economy toward the end of this year and into 2022.
Excellent. Dr. Seigel, this is Paul. I just want to interject and I guess redirect the focus back on inflation, right? The topic du jour.
Yeah.
In your slides, you cited, the growth in money supply, in particular, the tremendous leap that we've seen as of late. However, when looking at the velocity of money, that has still been anemically low. What is your take on the influence of velocity of money with the money supply, and maybe does that explain some of, maybe not necessarily deflation or the disinflationary arguments that are around?
And that's a very good question. So let me explain a little bit to maybe some of the listeners what velocity means. It's how fast money circulates in the economy. You get in your wallet, you hold in your wallet or your bank account, then you spend it, the bank gets it, then it finally goes back and recirculates. If the Fed prints more money and its circulation rate goes down, it won't put pressure on prices. But the money supply growth of the magnitude I saw, at least historically, has by and large gone into prices. In other words, I don't think that that we can slow velocity up enough to prevent that inflation. And let me mention one reason why. And that is because, as I said, we've had a 40-year decline of interest rates, and economists know that velocity is tied to the interest rate. The lower the interest rate, the slower the money circulates, because you're not getting much of a return on that cash. You hold it longer. But with interest rates not going down anymore, and in fact going up, that slowdown in velocity that we've seen over the last 40 years is unlikely to repeat itself. Now,
so, Dr. Seigel, where do you see interest rates going at the end of this 4-year period?
Well, I see, because the hedge demand is still so strong, I do see the 10-year bond to be around 2.5% to 3%. Now, could go higher, and it'll still stay below inflation because there's this hedge demand that didn't exist in earlier times, and that's why we had 16% 10-year, even though we only had 9 or 10% inflation. So it'll go up, but won't match inflation. So we're going to see interest rates. Now, how far they're going to have to hike inflation on the short side, they got to get, right now, a lot of speculation on people saying get zero in the bank. I might as well put it in meme stocks. I might as well put it in NFTs, all these crazy, I think, investments that, crazy now, it's, I don't want to use crazy, but I think once interest rates start rising and people can get some cash return, will wash out some of the speculative excesses that we see. And by the way, I'm not calling this market a speculative excess. I'm just saying the meme stocks, the Reddit stocks, some of these others are the ones that, when you have a zero interest rate environment, that sort of investment or speculation is encouraged.
Excellent. Well, Dr. Seigel, I think that concludes all of the audience's questions. I want to thank you again for your time and your wisdom today.
Thank you.
You're welcome. We also do want to extend our gratitude to Chris Murray and the Wisdom Tree team for making this event possible. As Michael stated, there will be a replay of this event distributed shortly. We do want to thank our audience for attending, and have an excellent day.
Thank you very much.
Stay well. Thank you, Doctor.